The Financial Services Commission has changed the rules for the insurance industry, but why and what does it mean for you and your money and your insurance bill? I'm Khalila Reynolds, financial journalist and educator based in Jamaica. The FSC just changed the amount of money insurance companies need to have in reserve, and watch to the end, I'll explain how this affects you. So back in January, Jamaica adopted International Financial Reporting Standard 17, which is exactly what it sounds like, an international standard for reporting. And it's actually a big deal. One of our analysts, Clive Charlton, explained what it means.
It's really putting in place that we can compare financial statements easily, as well as analysts are able to disaggregate figures and information in financial statements easily. Sometimes you have to dig so hard in a financial statement to get information that is very tedious and you may not get to the bottom of it. So IFRS is really standardizing reporting, of financial statements so everyone all over the globe and any jurisdiction can access the critical information correctly and easily, right? And we should all come to the same, or more or less, the same calculation in terms of value. Not necessarily, but should. IFRS 17. There are certain standards that different industries must meet, and insurance is one of them. It was previously IFRS 4, that insurance company that really stated how insurance companies should report revenues and, of course, their costs, their liabilities, and their entire cost structure.
So essentially, IFRS 17 is a change in the way insurance companies report certain numbers. Because of that change, the FSC had to update some of its rules for insurance companies to balance things out. Under the FSC's previous standard, insurance companies had to have in reserve more than 150% of the total amount of money they would need to meet their obligations to policyholders and to withstand possible losses. So, for example, if they need $1,000 to be able to pay you if something goes wrong, then they needed to have at least $1,500 in reserves. But with the new standard, companies now only need to have over 100% in reserve, so that drops the $1,500 down to the $1,000. The FSC based this new standard on the one that Canada used in 2018. But Khalila, why should I care about any of this? Well, if you watched this video, then you know general insurance rates are up 50 and even 60% this year. And that's because local insurers are under a lot of pressure. Interest rates kept going up, plus the rates from reinsurers were going up. Then consider the over 150% that they had to have in reserve. All of that added up to insurance companies charging you more money every month to cover their bases. So this change in capital adequacy requirements means a little less pressure on insurers and hopefully no further premium increases for you. Now, this is just one factor that contributes to premium costs, but it is a step in that right direction. And that's the bottom line. What do you guys think about this update? Do you think insurance companies could stop raising monthly premiums? Let me know in the comments. Subscribe to my newsletter for money news like this straight to your inbox. Click the link up here or in the description below. Let's get this money.
Let's get this money.